Hi, I'm Paul Feinberg, and we're here today with Dr. Bruce Carlin, Assistant Professor of Finance at UCLA Anderson School of Management. Our topic today is consumer credit. Bruce, a lot of pundits in the news use the word crisis when talking about consumer credit. Is that the word you use? Are we in a crisis, and how would you describe the current state of consumers and their savings and their credit?
Well, I think crunch is probably a better word. I don't think we're necessarily in a crisis at this point, but access to funds has been limited. It is affecting the housing market. It's affecting new construction. Builders have had to abandon projects in the middle of construction. And now, even in the west side of LA, you'll see that there are properties where there are foreclosures and so forth, which is something very new to us. So it's definitely affecting access to funds. Some people are focusing on what to do about the current crunch. What I typically feel is that we should be also looking at what caused the crunch. I think some of the disclosure that consumers have when they get loans or when they invest their money in mutual funds needs to be clearer so that people know what they're getting and why they're getting it and what they're paying for it. And a lot of this might have been avoided with better disclosure and better incentives in the market.
Now, you've written and researched this topic, and I know you've come up with some interesting discoveries and also some paradoxes in the research. Can you discuss that a bit?
Yeah, so most people think when there's higher competition in the market, this should drive prices down. And that's pretty much a tautology in economics. But oftentimes we see that increased competition may lead to higher prices. And so what I've studied is how firms compete not only on price, but also on the complexity of their price. And what I've shown is that it's a general result that as more firms compete in the industry, they raise the complexity of how they disclose their prices. And this is not a collusive result. This is actually a non-cooperative competitive result. Well, as they tend to increase how opaque their prices are, this dumbs down the population and there are greater rents to be earned by the industry and prices can rise. So the policy ramifications are that we need to look at how to more clearly disclose information, not just to merely disclose it.
Can you give us some examples of, are we talking about mutual funds or what types of financial products are we talking about, and in what ways are they complex?
So for instance, if we just take the simple mutual fund, and in fact I can give you some evidence. The NASD ran a recent literacy survey in 2003, and they asked people who own stocks and mutual funds what they knew about the market. And while about 70 to 80% of the people knew the difference between various grades of bonds or the risk-return trade-off, things you'd find in a finance textbook, only about 20% understood anything about pricing. In fact, most people thought, or at least a third of the people thought, that no-load mutual funds means no fees at all. So the pricing they're very sensitive on pricing and information about pricing. So when you go to buy a mutual fund, there are loads, there are 12b-1 fees, there are management fees, there are a lot of indirect costs that investors pay, and the garden variety investor doesn't know what these things are. They don't even know that they're paying them. So when they're taking their savings, and we're encouraging them to save, and they're putting them into mutual funds, they may be paying a very high premium for this and not even know it. So the type of policy that might rectify this and get us into more of the competition causing lower prices would be to have maybe a one-price disclosure. This is the total percentage you will pay when you are at this mutual fund. And I think if there is more simplicity and people would understand more about what they're paying for the goods.
Is the same true for credit cards and other types of borrowing?
Sure. I mean, if you look at a credit card disclosure, it'll typically give you a teaser rate, and then there'll be footnotes that your rate will be different after 6 months, but it doesn't tell you exactly what it would be, and it refers you to other information. And it's hard for people to look at this and to make heads or tails of what their true rate's going to be in a long-term situation. And people tend to sign up for these credit cards and hold them for long periods of time. In the mortgage industry, closing costs are the same thing. People don't really understand closing costs, paying points, the benefits or costs of an adjustable rate mortgage. They don't understand these things. So it becomes, there are sometimes incentives to make things more clear, but with greater competition, there are also incentives to make it less clear.
Now, are consumers in a bit of a catch-22? On one hand, it's harder for them to borrow money, it's complicated for them to get credit, but also our economy sort of is counting on them to keep spending and keep spending. Sure. So what does a consumer to do in that situation?
Well, I mean, I think that fortunately or unfortunately, it's my opinion that with this, what we call a crisis, we should require better disclosure so that we can continue to encourage people to invest in the market and save and to try to borrow to consume, but do so in a safe way so that they can maximize the amount that they have for the future and maximize the consumption that they have. And it does have economy-wide ramifications. The more people have for the future, the more they can consume now, the more our economy thrives.
How does this play into the public's trust for markets and financial institutions?
Well, I mean, I think that trust is very important for growth. I mean, we know from a number of studies that the more trust you have, the more people are willing to put money into the market, the more capital in play leads to higher expected growth. So trust is a key in getting people to participate. And I've modeled this, I've developed a theory of how public trust forms, and the law is typically a catalyst for trust to form, but it does depend on the market. Sometimes it's a substitute for trust. The more law there is, the less people really need to develop trustworthy relationships and so forth because the law protects everybody. But in this case, it seems like disclosure law should help people continue to participate so that people don't stop participating after a bad event like this. We know from the Depression that people who grew up in the Depression don't like to participate in the stock market because that trust has been lost. So I think it's really important that the policies help to maintain trust in the market.
It seems as if there's three players. We have the government, in no particular order, the government, the public, and then the financial institutions.
Right.
And so, what are the different roles that each can play as we look for solutions? Is it enough to say the government needs to force financial institutions to simplify, or is there a burden on the public to become more sophisticated as the financial products they use become sophisticated?
Well, I think that, so I have really two responses. The first is it's easy to provide an economic model with just investors and firms and show that the market will break down. And I have a new paper on consumer protection laws in which I show that without any enforcement, without any law, the financial institutions cannot commit to high quality goods, and investors knowing this will basically decide, well, I'm not going to participate. They basically don't pay a high price, and it's a self-fulfilling prophecy where the market, really nothing of good quality gets produced. And this is kind of like a market for lemons type of result. And then I study how the government should intervene and how they should, what types of consumer protection laws should exist. So my one answer is that it's my opinion that the government should play some role, and it's to the financial institutions' benefit because they can make a better market and be able to charge higher prices and so forth for what they produce. On the other hand, I also we want to put some responsibility on the consumer for becoming financially literate. But we have to recognize that some people have greater access to that than others. Some people have friends in the industry, they can read the Wall Street Journal, they participate in the market as rather shrewd investors. But if we really want the general population to participate, we have to recognize that it's very hard to educate the general population. So I think that some effort we can put into educating people. I think that's a wise thing. But I think we also have to make sure that the firms are making it easy for them to use their education and access the market.
Now, is there benefit to the firms themselves as this goes on? Do they still make the profits they want to make?
Well, it depends. In certain circumstances, it'll naturally make things more competitive. It may be harder to turn a profit. These rents that I've been talking about will disappear. Of course, not everybody will exit the industry. And of course, some firms are providing differentiated services, and they'll have their patch, and they'll be able to continue to produce. But again, if we don't keep some stability, then the financial market can fail. And we know that from emerging markets, good financial institutions help promote growth. And without some sort of law, it seems like it may fall apart. But I mean, this is my opinion, of course.
Right. We who read the papers and follow the news know that much of the attention has just been on real estate crisis, real estate foreclosures, real estate. Is this other area of you said crunch, some say crisis? Is it getting enough attention? Are people understanding that there are credit issues other than just real estate?
Well, I think that they're unfortunately well aware. I mean, there are some people that are having a hard time making payments. I mean, it's affecting the middle class tremendously, because especially in times where the adjustable rate mortgage has adjusted up, now they're paying higher payments. They can't just refinance because the financing's not there, and it's really tough on them. And getting loans is tougher. I mean, banks are tightening their belts. So it's in this time period where it's hard to find money. And I think people are definitely aware that there's a liquidity crunch on all types of lending. But I mean, we've gotten through crises before, and I'm confident with our financial system that we'll be able to solve this, and we'll be okay. But I think that moving forward, we have to really look at what was the cause of the problem, and not necessarily just fix it this time and business as usual.